Welcome to the deep dive. Today we're digging into something really interesting. Aurinia Pharmaceuticals.
Yeah, it's quite the story.
You've got this company, right? They have an FDA-approved drug, LUPKYNIS. They're making money now. Things look, well, solid on the surface.
Profitable.
But then you peel back the layers, and it's this high-stakes situation. Patent challenges coming up.
Right, big ones.
An activist investor is basically calling the shots now.
Yeah, running the board.
And the leadership. Their actions kind of scream, we're prepping for a sale.
It definitely looks that way.
So we're going to unpack all that. The stock's at $9.04 right now. Does that price actually match up with what it's worth? Our analysis suggests maybe not. We're seeing a value closer to $10.47.
Exactly. That's the goal today.
Yeah.
We're going to cut through the noise around Aurinia Pharmaceuticals. That's AUPH on the NASDAQ.
And this analysis is fresh, right?
Right. Yep. Pulled all the financial and market data as of July 14, 2025. So the big question is, can Aurinia use its, specialized knowledge to build a real lasting advantage? Or is betting everything on one drug going to be its downfall?
Okay, let's start with the basics. What exactly is this business?
Business analysis.
Yeah.
A singular focus on lupus nephritis.
All right, so Aurinia Pharmaceuticals, they bill themselves as a fully integrated biopharmaceutical company. And like you said, they've hit profitability, which is a big deal for them.
Mostly thanks to LUPKYNIS.
Almost entirely. That's their flagship drug. And that leads right into the core tension.
Yeah.
Can this super focused approach, relying just on LUPKYS, give them a sustainable edge in the autoimmune space? It's a tough market.
Especially with patent fights on the horizon.
Exactly. And just to anchor us, all this analysis is based on data up to July 14, 2025, with that share price at $9.04.
So how do they make their money? It sounds pretty straightforward.
It is, relatively speaking. Their model is focused on autoimmune diseases with significant unmet needs, the main chunk of revenue. Direct sales of LUPKYNIS right here in the U.S.
And they use special pharmacies for that.
Yeah, a network of just 2 specialty pharmacies handles distribution. But there's another piece. They get license fees, collaboration payments, and royalties from their partner, Otsuka Pharmaceutical.
For overseas sales.
Right. Otsuka handles LUPKYS development and sales in places like Europe and Japan. Aurinia gets high-margin payments like milestones and royalties without needing its own huge global setup.
Okay, so LUPKYS is the star. Tell us more about it.
It really is the cornerstone. Oclosporin is the generic name. Right now, it's their only revenue generator. It's what's called a calcineurin inhibitor immunosuppressant. Basically, it calms down the immune system.
And the big deal was it being the first oral drug for lupus nephritis.
Precisely. Approved by the FDA back in January 2021, specifically for adults with active lupus nephritis, or LN. That's a serious kidney inflammation linked to lupus, SLE. It was a landmark, a targeted oral option where choices were limited.
Are they working on anything else? Any pipeline?
They do have one lead candidate, AUR200 or Eritinircept. It's still early days, phase 1 clinical development.
What does it do?
It's designed to inhibit 2 key proteins, BAF and APRIL, that are involved in autoimmune responses. It's basically their main shot right now at diversifying beyond just LUPKYNIS.
So they've managed to become a leader in this specific LN niche, even as a smaller company.
Yeah, they really have. Being first to market with an oral therapy was huge. Their market cap is around $1.22 billion, so they're definitely small cap, but their focus lets them compete effectively.
And the value for patients is the convenience and effectiveness.
That's the core of it. LUPKYNIS offers a targeted, effective, and maybe crucially, a much more convenient oral treatment. Think about it before this. Patients often relied on older, broader immunosuppressants, sometimes off-label, or steroids, all with pretty significant side effects.
Right.
LUPKYNIS has shown it works well in preserving kidney function and just generally improves quality of life.
Okay, zooming out. How big is this whole lupus market they're playing in? Is there room to grow even in this niche?
Oh, yeah. It's a pretty substantial market, and it's definitely growing. Globally, for SLE and LN combined, estimates put it around $2.85 billion in 2024.
Wow.
And it's projected to grow to maybe $4.44 billion by 2032. That's a growth rate of like 5.7% a year. Some forecasts for just the LN treatment part are even higher, maybe hitting $5 billion or more.
What's driving that growth?
A few things. More autoimmune disorders being diagnosed, partly due to better diagnostics and this big shift towards more targeted therapies like LUPKYNIS. North America is the biggest market now, but Asia Pacific is expected to grow fastest.
Okay, but even in their niche, they've got competition, right? Who are they really up against?
Absolutely. It's never empty. Their main direct competitor is Benlysta from GSK. That's a biologic therapy.
GSK, that's a giant.
Exactly. Benlysta got approved just a month before LUPKYNIS, and obviously GSK has massive resources. Plus, Aurinia still competes against the older stuff, generic immunosuppressants like MMF, mycophenolate mofetil, and corticosteroids that doctors have used off-label for years.
And the key difference is LUPKYNIS being a pill versus Benlysta being an injection.
That's a huge differentiator, yeah. We highlight that in Table 1.1 in the analysis. And the whole regulatory scene, it's intense. FDA, EMA in Europe, PMDA in Japan. You need ongoing compliance, constant safety monitoring, pharmacovigilance, plus navigating drug pricing rules. It's complex.
So it sounds tough for anyone new to just jump into this space. The barriers must be pretty high.
Exceptionally high. And that actually works in Aurinia's favor, creating a protective shield. Sort of.
How so?
Well, first, intellectual property. They have patents on voclosporin running into 2027, some even out to 2037. Then, the R&D costs are just astronomical, hundreds of millions, potentially billions, over 10 years or more.
Oh.
Plus, navigating the complex regulatory approvals, running the clinical trials, and you need a specialized sales force. Just to reach the right doctors, the rheumatologists and nephrologists, it's a real gauntlet.
So that's their competitive moat then? How
Yeah.
do they actually use that day to day?
Right, that's where their advantage comes in. They've worked hard on brand recognition. Marketing campaigns like Time is Nephrons have really helped establish LUPKYNIS.
Okay.
And while they're not a pharma giant with huge economies of scale, their gross margins are really high, 88% in 2024. That's pretty typical for branded drugs. As sales volume increases, their operating leverage, their efficiency, should improve.
And you mentioned patients might not want to switch once they're stable on LUPKYNS, that stickiness.
Absolutely. If a patient's kidneys are doing well on LUPKYNIS, switching treatments feels risky. That creates real switching costs.
Makes sense.
Their unique assets are definitely their IP portfolio and their deep expertise in these diseases, which let them get that first oral therapy out there. And that oral formulation, that's not just a small thing. It's a really critical, durable edge over injectable drugs like Benlysta. It affects how doctors prescribe and how well patients stick to the treatment.
So it's like being the big fish in a relatively small pond.
Exactly. That strategy of dominating a specific high-need niche like LN creates a formidable barrier. They're the known experts in this space. It makes it harder for even a giant like GSK to just muscle in and replicate those deep relationships.
Okay, that gives us a good handle on the business itself. Now, this is where it gets really interesting when we look at who's steering the ship and how they're handling the money.
Managing evaluation, stewardship under scrutiny.
Right. So the leadership team, CEO is Peter Greenleaks. He's got over 25 years in the biopharma world.
And his track record is interesting.
Yeah, particularly his history of leading companies that ended up getting acquired. Sucampo, Biodelivery Sciences, and Terra's Pharma all sold under his leadership. It suggests he knows how to position a company for a strategic exit.
Which fits the narrative we're seeing now.
It does, especially when you factor in the big restructuring they did in 2024. They cut about 25% of their staff, stopped some R&D, like a program called AUR 300.
Why the cuts?
It was framed as a response to market conditions, but also, importantly, due to pressure from shareholders. This came after a strategic review in 2023, where they tried to sell the company but failed to get an offer.
And the activists weren't happy.
Not at all. Some were very public in their criticism, even calling for Greenleaf to be removed.
How's their communication been? Are they open with investors?
They use the standard channels, SEC filings, investor calls, website updates. But transparency, yeah, that's been a sore spot.
Especially around that failed sale.
Right. Activists felt they weren't open enough about why it failed. And more recently, they caught flack for not immediately disclosing 3 patent infringement lawsuits filed against generic companies in April 2025.
Wow. Lawsuits challenging their main DRINS patents. That seems pretty important.
You'd think so. Shareholders argued that was definitely material information that should have been shared proactively.
Okay, so how are they spending money now? Capital allocation?
After that 2024 shakeup, they've clearly pivoted. The focus now is laser sharp. Maximize LUPKYNIS sales and advance AUR 200 through the clinic. Other stuff, like AUR 300, got cut to save cash.
Have they done much M&A?
Mostly small strategic deals. Like in 2021, they bought Thunderbolt Pharma, which is how they got AUR 200 in the first place. But that big 2023 strategic review, where they talked to over 60 potential buyers but got no deal, That's still a major bone of contention for the activists.
They don't pay a dividend, right? Typical for biotech.
Correct. Never paid one.
Hmm.
But they had started buying back a lot of stock. The board authorized a $150 million buyback program in early 2024.
Have they used much of it?
Quite a bit. $41 million repurchased in 2024 and another $47.4 million just in the first quarter of 2025. That's usually a signal management thinks the stock is cheap.
And what about their returns now that they're profitable?
Yeah, their return on invested capital, ROIC, over the last year is somewhere between 6% and just under 10%. It's a positive sign they're actually generating profit from the capital they've invested.
So if you put all these recent moves together, Greenleaf's history, cutting R&D, focusing on the core assets, the big buyback.
It paints a pretty clear picture, doesn't it? It really looks like a company being methodically tidied up, streamlined, prepped for sale. These are classic moves right out of an activist investor's playbook.
And the activist isn't just on the sidelines anymore.
That's the kicker. Kevin Tang, who runs Tang Capital Management, the biggest shareholder, an activist fund, he was appointed chairman of the board in 2024.
An activist in the boardroom.
Exactly. That fundamentally changes things. Decisions now seem driven by unlocking shareholder value, likely timing a sale around key data, maybe that AUR 200 phase 1 data readout. That would be a logical point to maximize value.
But wait, you mentioned conflicting signals earlier. The chairman is buying shares hand over fist.
Millions of dollars worth, yeah. Aggressively buying on the open market.
How?
Late 2024, early 2025.
Yet the CEO and others are selling?
Significant net sellers in Q1 2025, yes. Now, the company ties those sales to performance awards vesting.
But it still looks weird.
It does create a conflicting narrative. You have the activist chairman doubling down, while the CEO and his team are reducing their stakes, even if it's part of their compensation structure. It adds a layer of, let's say, uncertainty for investors trying to gauge internal confidence.
Okay, we've got the business strategy, the management drama. What does the bottom line look like? How healthy are the finances, really, especially with this shift to profit?
Financial analysis. The journey to profitability.
Okay, financials. As of mid-July 2025, Aurinia's market cap is hovering around $1.22 billion, small cap territory.
And the revenue growth. You said it exploded after LUPKYNIS launched.
It's really a textbook biotech growth story. Sales took off after that January 2021 approval. We saw like 194% growth in 2022, then 31% in 2023, 34% in 2024.
It's a strong momentum.
Seems so. For the 12-month ending Q1 2025, revenue hit $247.3 million. That's up another 29.2%. So yeah, the commercial engine is still humming.
And they finally crossed over from burning cash to making it. That feels huge.
It's a massive inflection point. They've made the transition to actual profitability. Looking at the trailing 12 months, their gross margin is almost 80%, very healthy for a branded drug.
Wow.
Operating margin is over 17%, so they're comfortably covering costs, and net profit margin is around 16%. Solid.
What about cash flow? That's often the real test for biotechs.
Absolutely critical. For years, they burned through cash. The words was negative $158 million back in 2021. But in 2024, they finally hit positive annual free cash flow, $44.1 million.
And it's accelerating.
Yep. For the trailing 12 months through Q1 2025, it reached $64 million. Moving from burning cash to generating it like this fundamentally de-risks the whole operation. Table 3.1 in the analysis shows that transition really clearly.
So years of losses and now suddenly profit.
It's a defining moment. 2024 was their first annual net profit ever, $5.8 million. And just in Q1 2025, they booked $23.3 million in net profit.
How's the balance sheet look? Debt, cash.
Very strong, actually. Super conservative. Their debt-to-equity ratio is just 0.22, minimal debt risk. And they're swimming in cash, relatively speaking. Current ratio is almost 6, with $312.6 million in cash on hand. Lots of flexibility.
No dividends, we covered that.
Right, not applicable here.
So with all this positive financial momentum, how is Wall Street actually pricing this? What are the valuation metrics telling us?
Good question. If you look at the trailing price to earnings, the PE ratio, it's around 32.7. That's higher than the median for the medical sector.
Which might seem expensive.
On the surface, maybe. But the forward PE, looking at expected future earnings, is much lower, somewhere between 14.2 and 14.7.
So analysts expect earnings to grow fast.
Exactly. That lower forward multiple reflects strong growth expectations. Now, if we look beyond relative metrics to intrinsic value, we use an educational discounted cash flow model.
DCF.
Right.
Right. Projecting future cash flows back to today's value.
Precisely. Based on that DCF model, under a base case scenario, we calculated an intrinsic value for Aurinia of $10.47 per share.
Okay, $10.47. What are the big assumptions driving that number?
Key things include hitting their near-term revenue guidance. They guided $250 to $260 million for 2025. Then there's a long-term growth projection, about 12.5% annually over 5 years. And critically, the discount rate, or WACC, weighted average cost of capital.
Which reflects risk.
Right. It factors in their cost of equity using things like the CAPM model and their stocks beta, which is 1.1 seem, indicating slightly higher volatility than the market, and it includes their low cost of debt.
Okay, so we've dissected the business, the management, the financials. But what's the vibe on Wall Street? How does the broader market see this company, and who actually owns the shares?
Market sentiment. Gauging Wall Street's pulse.
Well, the vibe among Wall Street analysts covering Aurinia is overwhelmingly positive.
Really? Like unanimous?
Pretty much. The consensus rating is either buy or strong buy. We didn't find any sell ratings among the analysts we looked at.
In their price targets.
The average 12-month target falls somewhere between $10 and $11.50. Compared to the current price around $9.04, that implies, maybe 10 to 28% potential upside.
What about recent news? Has it been positive?
Generally, yeah. The tone has been mostly positive, mainly driven by them beating earnings expectations consistently and putting out good clinical data for LUPKYNIS and also some positive early signs for AUR200.
Okay, sounds pretty bullish, but is everyone buying it? What about short sellers?
Good point. Despite the analyst love, there is a notable amount of short interest.
How much?
As of late June 2025, about 10 million shares were sold short. That works out to roughly 7.6% of the public float.
Is that high?
It's significant. Anything over 5% usually indicates a meaningful chunk of the market is betting the price will go down. So there's definitely some bearish sentiment out there.
And technically, how's the stock trading?
Right now, it's actually trading comfortably above its key moving averages, both the 50-day, which is around $8.14, and the 200-day, around $8.09. That suggests positive momentum, both short and long term, though it did dip below the 200-day briefly back in mid-June.
So analysts are all thumbs up, but a decent number of traders are betting against it. That sounds like a disconnect.
It really is a significant disconnect. You've got the bulls focusing on the growth story, the profitability, the pipeline potential. Then you have the bears likely worried about that single product risk, the patent lawsuits, especially how management handled the disclosure, and maybe questioning if leadership can really deliver maximum value in a sale.
So as an investor, you need to figure out which side you believe more.
Exactly. You have to weigh those conflicting narratives very carefully.
Drilling down into who actually owns Aurinia is fascinating here. It feels like the ownership structure isn't just a detail, it's actively driving the strategy.
Ownership structure. Who holds the reins?
That's a great way to put it. Institutional investors, like mutual funds and hedge funds, hold a pretty big chunk, somewhere between 47% and 55% of the shares. That's fairly typical for a company this size.
Any big names stand out?
Oh, yeah. The ownership is quite concentrated. Tang Capital Management, the activist fund we mentioned, is the largest holder with over 10 million shares. Other big holders include BlackRock, Armistice Capital, NEA Management, and State Street.
And Tang Capital has been adding to their position.
Significantly, yes, in the most recent reporting period.
What about insiders, the execs and directors?
They also hold a decent stake, around 11% to 12%. But this is where we see that divergence again.
The chairman buying, others selling.
Right. Over the last year, insiders as a group were net purchasers, but that's almost entirely driven by Chairman Kevin Tang's multi-million-dollar buys. During the same time frame, especially Q1 2025, CEO Greenleaf and other execs were net sellers, mostly tied to those performance awards.
So that concentration, especially with the activist chairman, that's the game changer.
It absolutely feels like it. Aurinia's ownership isn't passive. It's an active, defining feature. Tang Capital isn't just any investor. They filed a 13D, signaling their intent to influence the company.
And getting Tang appointed chairman in 2024 cemented that.
Precisely. That activist in the boardroom dynamic completely reframes the outlook. Decisions now seem squarely aimed at unlocking shareholder value. The cost cuts, the R&D focus, the buybacks, they all look like steps to polish the company up for a potential buyer.
That kind of concentration can be powerful, right? Force change quickly.
Definitely. It can accelerate value creation. A small group of aligned, powerful shareholders can push through major strategic shifts much faster than if ownership was widely dispersed.
But there's a downside risk, too.
For sure. It puts the company's fate largely in the hands of a few players. Minority shareholders might find that the controlling group's agenda may be a quick sale at a price they think is too low, doesn't align with their own long-term view. Plus, if those big holders disagree amongst themselves, you could end up with messy, value-destroying proxy fights.
Okay, we see the opportunity, driven partly by this ownership situation, but biotech is always risky. Let's dig into the specific headwinds Aurinia might be facing.
Risk assessment, navigating the headwinds.
All right, risks. A quick SWOT analysis helps frame things. Strengths. Definitely LUPKYNIS being a market leader. The new profitability and strong financials, cash flow, low debt, lots of cash, plus their focused expertise and experienced, albeit scrutinized, leadership.
Weaknesses are pretty clear, too. That massive reliance on LUPKYNIS, over 98% of revenue, that's huge concentration risk.
It really is. Plus the limited pipeline, just AUPH 200, really. They're smaller size compared to competitors.
Yeah.
And those management credibility questions raised by the activists.
What about opportunities?
Big ones include expanding internationally through that Otsuka partnership, potentially getting LUPKYNIS approved for other related conditions, and of course, AUR 200 turning into a success would be huge. Plus, given everything, a strategic acquisition seems like a very real possibility.
And the threats. We've touched on some already.
Yeah, the biggies are definitely those patent challenges. Active lawsuits are already happening, which could lead to generic competition sooner than expected. Ongoing pressure from GSK's Benlysta. And then regulatory stuff like pricing pressure from laws like the Inflation Reduction Act and the inherent risk that AUR 200 might fail in trials.
Let's dig into those threats a bit more. How do broader economic factors play in? Inflation, interest rates.
They definitely matter. The Inflation Reduction Act, the IRA, is a direct threat. It allows Medicare to negotiate drug prices eventually and penalizes price hikes faster than inflation. For a drug like LUPKYNIS, that puts a potential cap on long-term pricing power.
And just general inflation hitting costs.
That, too, impacts operating expenses. Interest rates are also key. Aurinia is a growth company, so its valuation is sensitive to interest rates. Higher rates mean future cash flows are worth less today, potentially lowering the stock price and making borrowing more expensive. Lower rates could boost the valuation and maybe make M&A more likely.
You mentioned the IRA hits LUPKYNIS harder because it's a small molecule drug.
Yes,
Yes.
this is a crucial nuance. Small molecules like LUPKYNIS can face Medicare price negotiation just 9 years after approval. Biologics, like Benlysta, get 13 years.
Wow, 4 years less?
It's a big difference.
Yeah.
It basically puts a ticking clock on LUPKYNIS's peak profitability window. That ramps up the pressure to maximize revenue now and makes AUR 200 even more strategically vital. It could even impact the price they get in an acquisition.
Any other specific risks?
Yeah.
Geopolitical?
There's one that's specific to their structure, though maybe hypothetical for now. Aurinia is based in Canada, but makes most of its money in the U.S. If, say, the U.S. were to impose significant new tariffs on Canadian goods that weren't covered by trade agreements.
Like a 25% levy or something?
Yeah, something substantial like that could theoretically devastate their financials. It could wipe out their gross margin or really hurt their U.S. market access. It's a specific risk tied to their cross-border setup.
Okay, so pulling all of this together, the growth, the profits, the activist chairman, but also the single drug risk, the patent clock, the competition. Where does this leave us? Is Aurinia a hidden gem ready to be bought, or is it just too risky?
Conclusion: the bull versus bear thesis.
It really boils down to a clear dichotomy, doesn't it? You have this compelling story of growth, turning profitable, creating value.
Yeah, the bull case seems strong on the surface.
But it's set against these very concentrated, very high-stakes risks. Whether you think it's a good investment really depends on which side of that argument feels more convincing to you.
Okay, let's quickly recap the bull case. Why would someone be optimistic?
Point 1. Proven success. LUPKYNIS is a winner. First-in-class, oral drug, growing strongly, has real advantages. Point 2. Financial strength. They've turned the corner to profit, generating cash, minimal debt, tons of liquidity, a fortress balance sheet, basically.
Right.
Point 3. Pipeline hope. AUR 200 offers that chance to diversify and drive future growth. Point 4. The activist catalyst. Chairman Tang is pushing hard to maximize value, likely heading towards a sale.
Makes sense. Now, the bear case. Why be pessimistic?
Okay, bear point 1. Extreme concentration risk. Relying almost entirely on LUPKYNIS makes them incredibly vulnerable. Point 2. The patent cliff. This is probably the biggest unavoidable risk. Active lawsuits could shorten that profitability window significantly.
The ticking clock.
Exactly. Point 3. Competitive and regulatory pressure. GSK isn't going away and the IRA pricing pressure is real. Point 4. Management and execution risk. lingering questions about past actions, and there's no guarantee they successfully sell the company or that AUR 200 actually works out.
So tying it back to valuation, you said the DCF model points to $10.47 per share.
That's what our base case educational model suggests, yes. $10.47 per share.
And the stock is currently trading around $9.04.
Right. So comparing the current price to that calculated intrinsic value, it suggests there might be a potential discount of around 14%.
And the Wall Street analysts seem to agree, with targets mostly between $10 and $11.50.
Correct. So you could argue the market isn't fully appreciating their profitability, their strong balance sheet, and maybe the likelihood of that strategic exit.
Yeah.
But you absolutely have to weigh that potential upside against those very real, very significant risks. The single product dependency and the looming threat of generic competition are huge. Ultimately, deciding whether the potential reward outweighs those risks is the core investment decision here.
It makes you think, doesn't it? For a company like Aurinia, one big drug, that shortened IRA clock ticking down.
Yeah.
Maybe that activist push for a sale isn't just about maximizing value. Maybe it's literally a race against time.
It adds a real sense of urgency.
What does that ticking clock make you think about when looking at other biotechs, especially ones relying heavily on a single patent or facing similar regulatory hurdles down the road? Something to chew on.
Definitely food for thought for future investments in the sector.
Like and subscribe to Stock Analytics AI. For $4.99 a month, members get priority deep dives on tickers. We're tackling all the S&P 500 stocks over the next few months, and members get first dibs. Want a one-off deep dive? Just drop us a super thanks.
And just a reminder, this analysis was generated by an AI system for educational purposes only. It should not be taken as financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions.